They waited for the silence. They waited for the year's thin hours when most traders logged off when liquidity dried up and the books were closing. Then on the final trading day, the cartel pulled the rug. If you are looking at your screen, you aren't imagining it. You are staring into a sea of red. Silver collapsing from mid-70s to near 70 in mere hours. Gains from the last 2 days erased as if they never existed. The timing feels cruel. Hours before a new year, hours before a psychological reset, your portfolio is bleeding out. For many stackers, this moment feels personal. You held through the volatility. You endured the noise. You believed the breakout was real. And now at the worst moment, the paper market punishes your patience. But I want to be very clear from the start. What you are witnessing is not a trend reversal. It is not the death of silver. And it is not a failure of the thesis. This is a liquidity event, a mechanical event, a forced event. And if you understand why it is happening, this crash stops looking like a betrayal and starts looking like a setup. This is the final paper flush of the year, a dash for cash driven by rules, not fundamentals. The largest banks on the planet are not trading. Today, they are accounting. At midnight, regulators take a snapshot of their balance sheets. That snapshot determines capital requirements, penalties, and systemic risk scores for the entire year ahead. Volatile assets raise that score. Cash lowers it. So the incentive is simple and brutal: sell it all first. Ask questions later. In this emergency market analysis, we are going to dissect the New Year's Eve massacre. We are going to explain why silver and gold are falling together, why this selling has nothing to do with demand or shortages, and why this exact pattern has historically preceded one of the strongest seasonal rebounds of the year. The bullion banks are cleaning their books. They are shaking the tree one last time before the calendar resets. Do not let them steal your cheap silver. This is not capitulation. This is the test before the turn. And if you stay with me through this breakdown, you will see why the next move may be faster and more violent than the drop you are watching right now. If you are ready for Chapter 2, type 1. If you want to stop right here, type 2. And if this analysis helps you stay grounded in moments like this, please subscribe to the channel and leave a comment with one below so I know you are watching closely. To understand why silver is dumping today, you have to step inside the mind of a banker on December 31st. Today is not a trading day for them. It is not about profits. It is not about real price discovery. Today is an accounting deadline. At midnight, regulators freeze time and take a photograph of every major bank's balance sheet. That single snapshot determines capital requirements, penalties, and risk classifications for the entire year ahead. If a bank is holding assets labeled volatile, at the moment that picture is taken, its systemic risk score rises. A higher score means billions of dollars in additional capital reserves must be posted. That is real money immediately locked up and removed from circulation. So the logic is cold and efficient. You liquidate anything that increases risk. Gold, silver, equities, bonds. You raise cash because cash is the only asset that reduces the risk score. This is why the selling feels aggressive and irrational. It is not responding to headlines. It is not responding to supply or demand. It is mechanical. These banks are dumping positions into a thin holiday market to dress the window. When liquidity is low, every large order carries more weight. A few thousand paper contracts can push prices violently. This is why you see oversized red candles that seem disconnected from reality. The market is thin, the buyers are gone, and the sellers are forced. That combination exaggerates every move. It creates the illusion of panic, but illusion is the key word. Once the clock strikes midnight, the rule no longer applies. The snapshot is taken, the pressure lifts, the incentive flips from selling to rebuilding long positions. This is why these events so often resolve with sharp reversals in early January. The same institutions that sell to comply with year-end rules are free to buy back days later. The sell leg happens when no one is watching. The buy leg happens when everyone returns to trade. So when you see silver falling today, you are not watching value being destroyed. You are watching risk being temporarily reclassified. The spot price is not telling you the metal is unwanted. It is telling you that cash is momentarily scarce. And scarcity of cash always creates volatility. This is the context most paper traders miss. They react to the chart and ignore the calendar. But the calendar matters more than the candle right now. Now let's zoom out and look at what the market is really signaling, because silver is not falling in isolation. Gold is being hit at the same time. When you see both metals selling off together, that tells you something critical. This is not a silver story. This is a macro liquidity event. Gold is down sharply, and when gold sneezes, silver catches a cold. Silver is a smaller, thinner, more volatile market, so it amplifies whatever force is moving gold. The force today is the U.S. fiat dollar. When banks sell assets to raise cash, they create an artificial surge in dollar demand. The dollar strengthens not because the economy is healthy, but because the system needs dollars to pass a regulatory checkpoint. This dollar spike acts like a wrecking ball. Everything priced in dollars gets smashed at the same time: stocks, bonds, commodities, and especially precious metals. But here is the part most people misunderstand. A liquidity crisis is temporary by definition. It is not a structural shift. It is a timing mismatch. The system is short dollars today, not forever. The Federal Reserve understands this. When dollar shortages appear at year-end, liquidity is often injected through repo market operations to prevent systemic stress. When that liquidity enters, the dollar weakens and assets reprice higher. We are in the eye of a liquidity storm. The winds are violent, but they do not last. This is why spot price moves feel so emotional. They are fast, sharp, and disconnected from fundamentals. The market is not debating value. It is scrambling for cash balance. Technically, the chart damage looks ugly. The short-term uptrend is broken. A large red candle has formed on the daily chart. Momentum traders see this and assume the move is over. Algorithms respond by shorting weakness. This creates follow-on selling that pushes the spot price toward obvious support levels. Right now, silver is testing a critical support zone. This is the line in the sand. If this level holds, the entire crash becomes a backtest of the breakout. Painful, yes, but structurally valid. And when markets survive these tests, they emerge stronger. This is the moment where perspective matters more than prediction. You are watching stress, not failure. And stress always reveals where strong, real support exists. Let's talk about that support, because this is where fear and opportunity collide. Silver has fallen hard, and emotionally it feels like the floor has disappeared. But markets always look the weakest right at support, not after it breaks. We are now testing a level that spent weeks acting as resistance. When price finally broke above it, that ceiling was supposed to become the floor. This is the moment where that theory is being tested in real time. Every time price dips into this zone, something interesting happens. Volume spikes. Smart buyers step in. That tells you absorption is taking place. Someone with size is standing in front of the selling and saying, "I will take it here." That is not panic behavior. That is positioning. Weak hands dump into strength, and strong hands quietly accumulate. This is also where technical traders and fundamental investors part ways. The technicians see a broken structure and assume more downside. The fundamentals crowd looks at the same price and sees a massive discount. The market uses this conflict to transfer ownership. It shakes out those who cannot tolerate volatility and hands the position to those who can. Now let's address the emotion you are feeling, because it matters. Yesterday you saw higher prices, today you see lower ones. Your instinct says you lost something, but ask yourself one question: did you sell? If you did not sell, you did not lose any ounces. The market did not take anything from you. It only tested your stacking resolve. Markets exist to test patience. They move violently right before turning, because that is when the fewest people are willing to hold. This drop is designed to make you question your stacking thesis one last time before the calendar resets. The banks need sellers today. They need liquidity. They need you to doubt. And here is the truth most people learn too late. Spot price is loud. Value is quiet. The price screams at you through a screen. Value sits patiently in the background, unchanged by candles or headlines. When price and value diverge, the huge opportunity lives in that gap. This chapter of the silver story is uncomfortable by design, but discomfort is often the admission price for asymmetric outcomes. Now we need to shift away from the screen and look at the real world, because this is where the paper narrative breaks down. While the paper spot price is collapsing, the physical real market is telling a very different story. If silver is trading near 70 on a chart, logic would suggest physical prices should fall with it. But they are not. Premiums are expanding, not shrinking. Dealers are holding the line. Why would a bullion dealer refuse to lower premiums amidst a market crash? Because they know the divergence between paper price and physical value. This sell-off is in paper contracts, not real metal. If a dealer sells inventory cheap today and spot snaps back, they cannot restock that silver without taking a loss. So they protect themselves by pricing for physical reality and certainly not for paper panic. This divergence is one of the most reliable signals in the silver market. When spot crashes but street premiums stay firm, it signals there is no real-world capitulation. No one is lining up to sell their physical metal. The only selling is happening on screens by leveraged traders who do not want delivery. This is why the physical market matters far more than the paper market. Paper trades emotion and leverage, physical trades necessity and true scarcity. The physical market moves slower, but it always tells the truth. Now think like an industrial buyer for a moment. If you are a manufacturer needing silver to operate, a sudden spot drop is not scary. It is a gift. It allows you to lock in bullion at a lower cost. That buying creates a natural floor. Below a certain level, silver is simply too cheap to ignore. While banks are dumping paper to clean their books, industry is quietly taking delivery. That metal leaves the vaults. It does not come back. Every ounce that moves into production tightens the future supply and increases pressure on prices later. This is how shortages deepen during market crashes. Volatility transfers silver from weak hands to strong hands. Once that transfer is fully complete, the real imbalance reveals itself. What you are watching is not price destruction, it is asset redistribution. There is another layer to this move people miss, and it lives in the derivatives market, to force spot lower. Today, banks selling had to lean on the short side again. That means new shorts were open to drive the market down. In other words, to smash spot, they stepped back into the same trap they were trying to escape earlier in the week. This matters because every short sale is a future obligation. Every contract sold today must be bought back later. The more aggressively spot is pushed down, the more potential energy is stored in the system. Volatility works like a coiled spring. Compress it hard enough and the release becomes violent. Short sellers understand this well. They may enjoy the current move, but they also know the calendar. Staying short into the first trading days of January has historically been dangerous. When liquidity returns and buyers reappear, shorts scramble to exit. That scramble becomes fuel for the rebound. This is why crashes driven by forced selling often reverse faster than anyone expects. The same participants who push the market down become the buyers who pull it back up. They cover not because they are bullish, but because they are overly exposed. Now let us bring the calendar back into focus. January matters because new money arrives, pension allocations, institutional flows, fresh contributions. These funds do not wait for perfect charts. They deploy on schedule. Right now, the silver market is illiquid. In a few days, it will not be. When that new capital meets a suppressed spot price, the imbalance flips. The vacuum that pulled price down becomes the vacuum that pulls it up. The slingshot is being loaded. This is why timing matters more than emotion right now. Today is about survival, not action. You protect capital by not making fear-based decisions. You prepare, you observe, and you let the forced sellers finish their dirty work. This chapter is about patience under pressure, because the people who benefit most from the next move are the ones who did nothing during this sell-off. Now, let us address the elephant in the room, the question no one wants to ask out loud. Could this be the top? Could silver fall much further from here in markets? Anything is possible in the short term, and pretending otherwise is dangerous. But probability matters more than possibility. And when you weigh the probabilities, the bear case collapses under its own faulty logic. For silver to experience a sustained collapse, the world would need to enter a deep deflationary depression. Factories would have to stop producing. Demand would have to evaporate. Debt would have to shrink instead of grow. That is the only environment where a real lasting collapse in commodity prices can occur. And if that environment ever appears, the policy response would be immediate and overwhelming. Liquidity would be injected on a scale that makes previous interventions look rather small. That response would be wildly bullish for hard assets. So the bearish scenario actually circles back to the same conclusion. More currency, more stimulus, more pressure on purchasing power. In every path forward, the long-term case for silver remains intact. The spot price may fluctuate, but the destination does not change. This is where mental framing becomes critical. The market wants you to focus on the last few hours. You need to focus on the next few years. Spot drops feel catastrophic when viewed in isolation. They feel irrelevant when viewed in full context. Right now, you are not being tested on your analysis. You are being tested on your discipline. The market is trying to shake you out before the next phase begins. It is offering you cash certainty in exchange for future regret. Strong hands are not defined by perfect timing. They are defined by consistency under stress. They understand that volatility is the cost of admission and certainly not a signal to exit. This chapter of the story is about resolve, because the people who endure this moment are the ones positioned for exactly what comes next. There is another invisible force pressing on the market today, and it has nothing to do with silver itself. It is the calendar weapon known as tax loss harvesting. December 31st is the deadline. Funds that are sitting on losing positions from past years sell them now to offset gains elsewhere. They are not making a statement about the future. They are making a clear statement about taxes. If a fund manager made a fortune in technology or equities this year but is still holding silver-related positions bought at higher levels in previous cycles, today is the day they dump them. Not because they hate the asset, but because they hate paying unnecessary taxes. This selling is mechanical, not emotional, and it vanishes the very moment the calendar flips. What happens next is predictable. On January 2nd, the tax year resets. The reason to sell disappears, and many of the same managers who sold the book losses turn around and buy the position back. This is the wash effect. It depresses prices in late December and ignites rebounds in early January. History is full of these patterns, but they only become obvious well after the fact. This is why December declines often feel unjustified, and January rallies feel sudden. The pressure is not organic. It is scheduled, and scheduled pressure always expires. Now layer that on top of thin liquidity, regulatory selling, and forced shorts, and you get the kind of violent move we are seeing now. Not because silver is fundamentally weak, but because the market structure is temporarily distorted. Understanding this does not make the move less painful, but it makes it less confusing. Confusion causes panic. Clarity restores your control. This is the phase where the emotional crowd exits and the prepared crowd gets ready. The selling is nearly exhausted. The calendar is about to reset, and when the artificial pressure lifts, silver is finally free to respond to reality again. Now let us pull back and look at the macro picture, because this is where the current chaos starts to make sense. While silver is being forced lower by year-end mechanics, stress is quietly building across the broader financial system. Bonds are selling. Yields are rising. That is not strength. That is strain. Banks are liquidating assets across the board to raise cash, including trusted government debt. Here is the contradiction the market cannot escape. Rising yields tighten financial conditions, but the system cannot afford them. With debt levels this high, even small increases in rates explode interest costs. That pressure always leads to intervention. History is clear on this. When bond markets wobble, central banks step in. Liquidity returns, balance sheets expand, fiat currency is diluted. That response is not bullish for paper assets long-term, but it is undeniably bullish for hard assets. Every crisis plants the seeds of the next rally. Forced selling today creates the inevitable policy response of tomorrow. Sentiment confirms this setup. Fear is spreading. Frustration is rising. When investors begin to say the market is broken and nothing works, selling is usually close to exhaustion. Markets do not bottom when the news improves. They bottom when belief totally collapses. Bull markets are born in pessimism, and pessimism is everywhere today. That is not an ending. It is a market reset. This is the moment to stop reacting and start preparing. The panic is loud, but it is temporary. The next move will come before market confidence does. We have reached the final chapter, and now it is time to shift from diagnosis to strategy. The damage has been done. The forced selling has played out. The year-end pressure that drove this move is expiring. What remains is a market that has been fully reset, emotionally drained, and structurally prepared for the next phase. As the calendar flips, the rules change, the regulatory snapshot is finished, the tax loss selling is over. Liquidity returns as new capital enters the system, pension funds rebalance, institutions deploy fresh allocations. And critically, the sellers who dominated the tape days ago are gone. They already sold. That absence truly matters. As spot markets reopen, watch the price action, not the news. A solid open and holding the line signals the paper tamp is fully over. You do not need perfection. You need proof the naked shorting has finally ended. From there, the true path of least resistance for silver shifts straight back upward. For stackers, the lesson is simple. Focus on weight, not fiat price. Volatility does not change value. It reveals who gets it. This drop was not a failure of the thesis. It was a